computer. There we go. Okay, now we're recording. Any questions that you have about any of the material to be covered? Chapters 1, chapter 2, 11, and 12.
I think on 11, if I would like to clarify on how, like the difference on common stock and preferred stock and how to do the accounting. I'm kind of confused with both.
Okay. So common stock has no rights, really. Preferred stock has rights to first rights of dividends, and if they are declared. So let's go to, where are we at? Equity, right? Chapter 11. Oh, we want to go to the book. Let's see. I probably should share my screen, shouldn't I? Screen 2, share. All right. Can everybody see the textbook?
Yep.
Yep.
Okay. Let's go to here. Next one. Okay, I don't think it's here. Issuing stock, par value, common stock, more. Let's see. Where's the? Well, let's see if we can actually go to the quick. That might be faster. The cheat sheet. Maybe that'll give us a better view. Oh, we got a few more folks. Soledad and Nikki. Excellent. Welcome. Okay. If we look at the different transactions here, right? You got common stock at par value. And let's go down to, do they have preferred stock? There's dividends. Preferred stock. Okay. Basically the same thing. You got cash in and you're recording it to par and preferred stock at a particular par value. And then if there's anything greater than it, so in this case, it was $100 par value and they must have sold it at, looks like $600. No. Doesn't really say here, but they sold it over par. So it must have been $550. So it must have been $60 over, $60 over, no, 60. Sorry, I'm thinking.
It'd be 50 shares at $100 a share for par value.
Yeah, but I'm just thinking of the total number of shares that they issued. So it must have been 600 shares, right? Or 60 shares. Yeah, no, 60 shares. 60 shares, and that doesn't make any sense. Of course, I have to bring out my good old Excel file. So let's reverse engineer this transaction real quick. So in here they say the cash, the account, and you got your debit and your credit. And they said that 6,000 of that is what they got in cash, and then what they have preferred. And this would be 5,000. No, it's plus 5,000 or 550 times 100. Yeah, it's that okay. And then the excess paid in capital is the 50 shares times, what would that be, 20? So effectively they sold 50 shares for $1.20. Let's see it, plus 50 times 120. Yep, okay, now I get it. Sorry, I needed the Excel spreadsheet to kind of help me through the calculations. Doing it in my head, it usually doesn't work. So anyway, In this case, we see that, let's delete this. So we see that the company sold 50 shares of preferred stock at 120 per share. Okay, just as kind of a, you would probably get a question like this: the company sold 50 shares of preferred stock at whatever value, $120 a share. How do you record it, right? And so we know that the preferred stock is $100 par value. So that's the easy part. 50 times 100 gives you the 5. The other easy part is actually taking the 50 times 120 gives you the cash. So these two pieces of the transaction should be given. The other part that you don't know is the amount over the preferred, the par value. So you have to calculate that, come up with 1,000, and then that 1,000 is in excess of the par value. So it's called paid in capital, excess of par value. Now, what's the difference, back to Magda's question on common stock, right? So if we go back up here to the common stock, in reality, there might not be any difference in terms of how you record it, except for the account that you use. Okay, so let's say the same transaction, go back to Excel, same transaction, but instead of, we'll move this one up here, right? This is what you got. Instead it might be company sold, goodness gracious, sold 50 shares of common stock at 120. Well, let's just say that the par value is the same per share, with par value, let's say par value of 100. Okay, let's just make this a little bit smaller. Hopefully everybody can see this. Yeah, no. Oh well, I don't have my full thing anyway. So then if I just take the same journal entry view, and instead of these values, actually I'm gonna have the same values. Only difference though is I would have, this is common stock, and this is the excess. This is what called paid in capital in excess common stock. Okay, that's effectively how that's going to look. Uh, 20. Does that help a little bit, Magda?
Yes, thank you.
You bet. So really the only difference between the two are, the common stock is subordinate to preferred stock when you issue dividends. So dividends will first go to preferred stock and then to the common stock, depending on what their rights are for preferred dividends.
So, Brian, preferred stock always takes a priority over common stock?
Yeah. So
Okay.
let's say, yeah, so if you declare dividends in a given year, but you haven't paid them out, then depending on what the preferred stock rights are over time, they get paid out first to the preferred stock, and then anything left over goes to the common stock holders. See, it says right here, preferred stocks are paid both current and all prior periods unpaid dividends before any dividend is paid to common stockholders. That's the primary difference between common stock and preferred.
Okay. I have a question about stock. When stock is being, I guess, traded in exchange for a service.
Yeah.
So instead of cash being increased, you're going to increase will it always be a particular type of an expense account?
It could be. It depends on what type of service is being provided.
Okay,
But-
so you really have to pay attention to what the service is.
Yeah, so like in this case, so they stock and exchange for services, right? The exact question you had. They booked this. Organizational expense are usually an asset. And so they booked this to an asset account. It could very well be an expense account, right? So
Or could it also
somebody-
be a revenue account?
no, because that would be on the
Or-
credit side, yeah.
Or not a revenue, like a consulting fee?
Yeah, well, yeah, that would be an expense. So anything that
Okay.
shows up on the debit side, because your issuance of common stock is always going to be on the credit side because it's an equity account, right?
Right,
So anything that offsets that would have to be on the debit side. So it could be a reduction in accounts payable, right? So if somebody owed you something, you've already booked it someplace. No, sorry, let me say that differently. If you owed them something, I'll show you instead of talking in the air. So if somebody provided services for you, right? So let's say Nikki provides strategic leadership services for say 10,000. Okay. This might be the first general entry, account and direct debit and credit. So this might be the first entry where you put in consulting services, right? Let's say it's for 10,000, right? And because we haven't paid her yet, it's going to go into accounts payable. Right?
right,
Okay, but we decide, oh, that was great leadership services. We're gonna hire her long-term. And instead of paying her out that $10,000, we're gonna exchange it for common stock. Okay, so I might do an exchange, a common stock for services performed, right? And in that, we would go, we would debit accounts
payable,
payable, right? It's the reason why I don't write these all out sometimes. And we do, let's say, just common stock. Okay, so the 10,000 is here and the 10,000 is here. Okay, you'll see that the net effect is that consulting services is still there at $10,000. That's the expense account, but accounts payable has a $10,000 credit and a $10,000 debit in it, which zeroes out and effectively then becomes common stock, right? It gets transferred in. Now, of course, you could have, if this is common stock at, let's say, a $10 a share par value, right? And we exchanged, let's say, 110, not 10,000. I'm going to say 1,000. No, I don't want to do that.
100.
Yeah, let's do 100. So 100 shares of common stock for services performed, right? Well, you know, $10 a share. This is going to be $10 times 100, right? So 1,000 goes to that account and then paid in capital in excess. A common stock would be the difference.
9,000.
Exactly. So that's how that transaction ends up showing up. Now that's whether you do, you know, services performed, land, cash, no matter what, anything over the $10 per share par value goes over to paid in capital. I got that wrong. That help?
That helps quite a bit.
Okay. So you'll generally be told what type of stock it is. You'll generally be told what the par value is, and then you have to figure out the rest. So if it's cash, it's a cash account. If it's land, it's a land account right here, right? Land and buildings, services, anything like that will be on your debit side. And then your equity side will be something like this. Either straight up common stock, if it's no par value, right? So let's go back over here. So at par value, pretty easy. Above par value, you have these two accounts, the common stock and the paid in capital in excess. If there's no par value for the common stock, they don't give you this at all, right? They say no par, then it's whatever you receive, whether cash, buildings, services, whatever on the debit side, it's just the same value on the credit side for the common stock, no par value. Stated value, par value, there's some nuances there, but basically the same thing. When they say stated value, it's going to be effectively par value. Same type of transaction, right? The only thing they're trying to trick you on is how they call it, stated versus par. Issuing common stock for non-cash assets, same thing. Whether it's cash, anything that's an asset or an expense that's being traded, you'll always have that debit going to that original, that value that's being given to the company in exchange for stock. Okay. So much excitement out there. Any other questions on common stock?
So then the company receives the cash or the land for the price, and why is it divided into the paid in excess and the common stock or the preferred stock?
Why does this happen right here?
Yeah, so is it necessary to record the excess? Like,
Yes.
kind of based on what does the difference make to record or not record the excess, the paid excess?
Yeah. Okay, so I'd say it's kind of an accounting approach to splitting out the values, so you always know how much was paid just for the stock itself at par value. So let's say in this case, over time, this account builds up, right? This common stock builds up. You can always reverse engineer how much stock has actually been sold. Very similar to how I did the other, instead of doing there, I'll just do a calculator. So you can always reverse engineer how much shares are outstanding. So if I take 80,000, right, divided by 20 par value, I know that 4,000 shares have been issued by the company. Now, the amount above and beyond the par value, I don't necessarily know, but if I wanted to run an average value above and beyond the par value, then I do the same value of 4,000. I take $25,000 here, divided by 4,000, and I know that the average price above par value for the stock is about $6.25 over par value. Or another way of saying it is that the average market value when it was sold was 26.25. So there's a couple of analyses you can do because you split it out when there's a par value. If there's no par value, it's hard to tell exactly those same types of things. You have to be given how many shares were sold, right? What the market price was when they sold, stuff like that.
Okay, thank
So
you.
yeah. But anytime if it was sold at $30, then you'd always split it out, $20 for par value and then the $10 paid in capital in excess of par in those two different accounts.
What happens if it's sold for less? Does that does that happen in real life if it's not sold for the par value, or does it need to be sold by the par value?
Yeah, that's a great question. Then it would come, I think, trying to think through this. So if it was sold for less, let's go back up here, right? Let's say this one was $80, right? $80 a share. So you go equals 50 shares times 80, right? You get 4,000 here. The par value on this is still the 50 shares at 50 shares at $100 because that's the par value. But instead of this being a debit, it would have to be a credit of the difference. Right. So that reduces the the paid in capital in excess for common stock. So that's essentially the journal entry you have to do on this type of transaction, but I don't think you'll see that too often. Usually the par value on the shares are pretty low as compared to their market price.
Okay, so you don't use a different account. You use the same paid in excess, you just debit it.
Mm-hmm. Yep.
Okay.
Yep. Okay. All right. Any other questions on stock? You will get some questions on the difference between when it was declared, when it was recorded, and when it was paid. I think you've probably seen that in a quiz question or two. So you want to be careful about, when in the problem, recording it when it was declared versus when the date recorded and the date paid. So
Recorded
record.
Recorded is not posted in the journal, but declared and paid are.
Yes, exactly. Because the minute that it's declared effectively, not the minute, but the date that is declared, let's say in the board of directors meetings, an accountant will go in and actually record that in the books. Okay, that's why this shows up. Retained earnings, common dividends payable. Then the minute it's paid out is the minute that it gets removed out of common dividends payable and credited in cash. So this is an equity account, right? This is a liability account, and this is the liability account offset, and then the cash. Okay. You can also do dividends in the form of stock, and this shows the same thing. So you'll notice a similarity. Retained earnings is credited just like it is here, but instead of payable, right, and then cash, it goes directly to the common stock dividend distributable first, and then paid in capital for the excess. And then when they actually distribute the stock, then it comes out of that distributable and goes into the actual stock being issued. So this is declared. I would really say that this is an issuance of stock, not necessarily payment, but because you only get a certificate, you don't get cash, right? It's not like you're giving them a check. You're just giving them a stock certificate. Okay. Any other questions about stock?
I don't have any.
Okay, just one little thing. Remember that treasury stock is a contra account because it's natural balance. Its normal balance is a credit. It reduces the amount in equity, right? So you see this as a debit here and a credit to cash. It's primarily because when you first issue it, it goes into this common stock account, right? This common stock account, that's when you issue it. If you buy it back, it's still theoretically issued, but the company owns it now instead of an external entity or a person. And so that's why it shows up on the common stock as a credit, because in one case, in this case up here, it's been issued. And in this case, now the company owns it. Okay, so it reduces the amount of equity because the company has paid out the cash for it. Let's see. Same things happening above and below. So you notice this one. This is where the treasury stock was purchased below, but it goes to a treasury stock account. Okay. Anything else on 11? You have this in the bag.
Yeah, it says in the list to study that we need to distinguish between the authorized share, issued share, treasury shares, and outstanding shares, but I couldn't find where the definitions are. So, I don't know.
Okay, let's see what we got here. All right. See if I can find the area that talks about that. Okay, so authorized shares are the total number of shares that the company has actually said that it could issue at some time in the future. So in this diagram right here, it's like saying, how would I say this? If I put this in our own personal terms, maybe even in, I don't know, let's call it in the gospel terms, it's perfection, right? It's the total value of what we could be at some time in the future. Right, but in stock cases, it's the total amount of shares that could be issued sometime in the future. Authorized and issued is the same stock, but it's actually been sold to somebody, right? So it's a subset. So we're not quite perfect yet. Some of us are in varying degrees of perfection, probably all of us about the same in reality and in perspective, eternal perspective, but there is an amount that's been issued. And then there's the issued and outstanding, which means that you actually have exchanged it. Let me see if I can provide some more. Yeah, okay, so the difference between issued and outstanding is then really the treasury stock. Right, the amount that you issued it, but then you bought it back. So in reality, it's not outstanding anymore because some portion of it you're holding. Right. So total amount that could be sold, the amount that has been sold out of that value, and then the amount that's been sold less what you've bought back is this value.
Okay. That
Okay.
makes
That's a little confusing because in the book I read, it said outstanding stock is stock held by stockholders. Like, I thought stockholders were different than the corporation.
That's where the issued comes in play. So the ones owned by the corporation would be subtracted from the issued amount, and it's what's outstanding.
Outstanding is owned by the corporation. Issued is what's totally issued. Authorized is the total amount of what they can sell.
Yeah, issued and outstanding. So, oh, let's look at that, see if we can find it. Outstanding stock is stock held by stockholders. So the issued would then be a corporation can sell stock directly or indirectly. To sell directly, it offers it to buyers, common stock. To sell indirectly, corporation, and sell it to some brokers, underwrite stock. Okay, well, I stand corrected then. Because from my standpoint, issued and outstanding are a little different, but okay. So then this, I would hold on to this then. Outstanding stock is stock held by stockholders. So the issued stock is an amount that's out there, but not necessarily held by an actual buyer or a stockholder. It could be included. It could be held by an investment banker and just not sold yet. Right? All right, clear as mud, or do we need any more on that? Okay. Any other questions on common stock or stock in general?
Maybe could you go over the difference, like when you do both common and preferred, when you issue both at the same time? Like there was a table where they explained how first they paid the preferred stock, but then they accumulates on the common stock, like how to figure that out, because there was explanation with year 1 and year 2 on how they paid and they hold some part, but in the quiz it said with year 3, so then that got me confused on how to how to add or how to accumulate with more time.
Right. Okay, so that has to do with the dividends being issued, not the actual stock itself. Because whether you issue common stock or preferred stock, you're going to record in the way we've already shown it. There's really no difference there.
Okay.
The issue is when you declare dividends and then pay it out later, right? And who gets paid first. So let me see if I can find that in here. Issuing dividends. Let's see if we can find an example that walks us through a full life cycle of that. Okay, not that one. See if we can actually find a sample question on that. It might be a little easier to walk through something that you'll actually see on, or a similar view of that here. dividend yields. Let's see, go back. Price earnings. Earnings per share. Earnings per share. Statement of retained earnings. Classified balance sheet. Stockholders equity. Preferred stock. Issuance non-cash. Par value, non-par, non-par. Stated value. Huh, maybe they don't have one in here. Let me go back to the last one. That's dividend. This is just dividend yields. This is not what I'm looking for. Let's see if the quiz access had it. Dividend yield again. Price earnings. Huh, okay, it doesn't look like you were quizzed on this at all. So let's go back here. I know there's an example. In fact, I remember going over this at one point. Let's see if I can find. See if we can find an exercise that does that.
I found an example on page 428. I don't know if you can find that.
On 428?
Yeah, page 428. But it has only 2 years, not 3. But maybe you can go from there and. And that's in the physical book. I don't know if you can find it in the.
I think this right here might be one that we can use. This is probably similar to what you'll see if it is on the exam. Dividends on common and non-cumulative preferred stock. I think we want to look at cumulative. I think this is one. Let's just try this. So we'll pick this off and come over here to good old Excel. Let me make this bigger. Did not come over. See if I can do this again. You may not be able to. I may have to. Nope. Okay. Maybe a subset. No, that's not working. Okay, for some reason I'm not getting what I need out of there, so I'm gonna have to split this up. Okay. So we have 8,000 shares, 80,000 shares. So we have shares of 80,000. Right? Of non-cumulative preferred. With a par value of $5. I'm just putting this in here so I can refer to it later if I need to. quantity par is $5. Okay, and also we have some common of 200,000, and that is $1 par value. Okay, so these are some of our initial starting points. During its first 4 years of operation, the corporation declared and paid the following total cash dividends. Determine the amount of dividends paid each year to each of the two classes of stockholders, preferred and common. Okay, so this is 7.5%. Okay, so we have, let's say year one. Let's see, year 1, 2, 3, 4. We have common, let's do preferred, and we have common. Okay, so each year, the preferred get the quantity times their rate, their par value times their rate. Okay, so that's $30,000 a year. Does everybody follow that part? This is what they're owed each year. Actually, let me fix these values so they don't move on me. Okay, so this is what is due each year. Now what they paid out is, let's go over here, 20, 28, 20,000, 28,000, 200,000, and 350. Okay, so effectively, this is what you're given. I'll highlight the items that you've been given. So you've been, let's make this a little bigger now that we've got everything here. Okay, so you're given this information. You're given this information. And you were given this, right? These are the pieces of information you're given. Sorry, for some reason that didn't happen. So you had to calculate this part for preferred, and that's by taking the quantity of shares times the par value times the rate. Their annual, we call it an interest rate, if you will, on preferred. So in this year, common didn't get anything because reality is, let's see, calculated. Insert. This is what they're owed. The preferred folks are owed. This is what they're paid. Okay, so, and we're going to make, let's see, variance. All right, so we're going to take the sum of these two numbers minus what was paid out. So we're off by $20,000 in terms of total payout in this first year. So in here, let me make these a little bit easier to read as we input them. All right, so since they were owed 30, but only 20 was paid out, this would be $20,000. That brings that to zero. In this year, $28,000, and this is zero. There's not enough money here to pay the preferred and the common shareholders. In year 3, though, you can pay the full amount, and what's left over is paid to the common shareholders. In this year, same thing, 30,000. and you have leftover 320, and that's what gets paid out. Okay, so this is calculated what is owed at a minimum for preferred, and this is non-cumulative, right? This is the non-cumulative scenario. I put this in here. I forget how to spell that. Is it double M's? Anyway. So in a non-cumulative scenario, this is how it would look. Does that make sense? I lose somebody someplace?
It makes more sense now with the non-cumulative, but the cumulative is what makes me confused a little bit.
Yeah. Okay, so in cumulative, you'd have to go one step further. Yeah, so let's take the same calculation, right, on the cumulative side. And let's let me change my view just a little bit, add little freeze panes. Okay. On the cumulative piece, we're going to do things just a tad differently. And I'm going to do this without changing the formulas too much. I'm gonna try to keep it just the way it was, right? So you got the non-cumulative way, variance is 0, but now we're going to go with owed to preferred. Call that as simple as I can. And I'm going to do that as what we owe them minus what we paid them. And that's the first year, it's easy math. Then we're going to take that balance from the prior year and do the same thing. What did we owe them minus what we paid them? Okay. And now that I've got that formula set up for the years 2, I can just copy it over and it'll carry over. Now you'll notice that 12,000 carries over through because we paid them what we owed them for each year, right? In years 3 and 4. So if we keep this exactly the way we have it now, on the cumulative side, the minute that we got to a point where there is some excess cash, which is in year 3, then we would pay the preferred stockholders what they're owed in arrears plus the current year. So this would be $42,000. And we'd have to reduce the 170. An easy way to do that is just go like, just take out your number there. And now you've got what would actually be paid for the common. And the rest of this would stay the same because you're caught up in year 3. Okay. But let's say for grins, okay, let's say for grins that this is more like 50,000 this year, and let's say 60,000 in the year after that. Okay. So in this case, then there would be $8,000 left over and 30,000 left over here. Okay. But let's say even for another grin, okay, the actual, so you'll notice that this amount stays not really the same. I mean, the 30,000 per year stays the same. This accumulates, let's say instead of $50,000, the number ended up being $40,000. Okay, so now we have to start all over again. And so what can I pay of this 40? Well, I can pay the $30,000. Actually, I can just pay, all I've got is $40,000, and I owe my preferred shareholders 42, right? So you can see this, that prior, this current. So the most I can pay is 40,000. So I caught up a little bit now, but now I'm behind. So common shareholders don't get anything. And then let's say that it's 60,000 this year. So then this, we zero those numbers out, we'd know we have to pay 32,000. Oops. And the remainder is $28,000. Does that make sense?
Yeah. So the cumulative is only on the preferred part. The common always gets, let's say, what is left over.
Exactly.
The
Yeah. So the preferred on the cumulative side, well, even on the non-cumulative side, the preferred always gets first dibs at the dividends, whatever they happen to be. And then anything left over goes to the common shareholders.
Okay.
So if you set up your, if you're in the exam and you do kind of what I just did, in either case, let's say you just do it on this one, you just set it, oh, sorry. You set it up sort of like this, where you have, first you calculate what is due to the preferred stockholder each year. Then you put in some blanks for what is paid out, but you just leave them blank here and you have an actual paid out amount, right? Then you're always trying to distribute the $20,000 in this case, first to the preferred and then to the common. And you just check the variances. Number one, have I allocated all the money? And two, is there anything accumulating over time for the preferred shareholder?
Okay.
Okay.
Will that percentage change every year, or will that always be the same?
It should be the same.
Okay. To make the calculations. Okay.
Yeah. Yeah, more than likely, this is the type of information they'll give you, like that I have highlighted. And what may change in the problems is whether it's cumulative or non-cumulative rights and the rate, right? And these other variables like how many shares, what their par value is, and what the rate of return is for the preferred shareholder.
Okay.
Okay.
Yeah, that makes it a lot more clear. Thank you.
Yeah, absolutely.
So I'm sorry, I have a quick question that's more of logistics. So on my dashboard, it has like exam 1, and then it has a second one that says exam 1 remotely proctored. And I just, why is there 2 that I have?
Well, it's the way the thing is set up. So you need to go in order to get to the exam correctly, you should go to the modules, to the actual exam, remotely proctored, click on here. And then let me actually go to student view, just make sure I'm getting this. I see it the same way you do. So once you click, so modules, do this over again.
Okay.
And let's see, week 5, exam 1. You'll see the instructions, right? You'll take the quiz. By the way, you saw how it had that little temporary moment where it says access code required.
Yes.
If for some reason you get stuck there, that means your Proctorio is not working.
Yeah.
Then you should see this exam 1 remotely proctored, and then you hit preview quiz. It'll take you, where will it take you? Take you here, click on the exam, and you take the exam.
Okay.
Theoretically. There we go. It's launching. Oh, I am. And then you begin.
Okay.
Okay.
I see.
When you're done, you come back and you say, yes, you've taken the quiz, and you hit submit.
Okay.
Okay.
I see.
If you run into any problems, usually the issue is with Proctorio, so contact them.
Okay.
If they can't help you, contact the testing center, and then just let me know you're having issues.
Yeah.
Okay.
So Brian, if I could say something about that.
Yeah.
What was it, week 3, we were supposed to do our practice. It took me 9 times of removing and reinstalling Proctorio before it would finally take.
Yeah.
So
Yeah, it's the one little technical
Yes.
difficulty.
Sometimes it can be quirky, so just be patient, and whatever you do not wait till an hour before the exam ends to try to take your exam.
Yeah, you're not doing yourself any favors.
No.
You'll just be stressed out. That's all. Letitia, is that good? Answer your question?
Yes, thank you. Yep, that was great.
All right, perfect. Anybody else? Nikki?
I'm good. Thanks.
You're good?
Yep. As good as I can be at this point, I guess.
All right. Don't feel defeated yet. You can wait until after the exam, but
Okay.
before that, I feel like you got this.
Yeah, I don't do great on tests, so we'll see. I'm not a good test taker. So
All righty.
we'll see tomorrow night how I feel.
Yeah. Any particular problems you have taking tests or any?
I just have a tough time. Like, I think I get flustered and I forget everything.
Oh,
And
yeah.
I've
Same.
always been that way.
Yeah.
Gotcha.
So I don't know. I
You've
know the
gotta
stuff,
send
but
that-
then when I go take the test, it's gone.
The fact that there's a
Yeah.
time limit, I know like we have plenty of time, but like the time limit, I just get so much anxiety from that. I don't know why. And it like floods my brain.
Yeah.
You know, I'll tell you what's helped me in the past with these are studying the cheat sheets. It's a great source of information there. And then the supplemental study material. That's a great additional source to help draw things in together.
Yeah, I've been using the supplemental, so I'm hopeful.
Yeah.
We'll see.
I'm sure you'll do just fine. It is a hard test. There are some, they test your ability to extrapolate what you've learned into situations that you may haven't necessarily been exposed to directly, right? So you
Yeah.
practice this stuff over and over, and then they'll throw you a curveball to see if you can adjust and take the learning that you've had on particular issues and apply it to something that sounds different, that looks different, right? And then do the exam. So oftentimes the way I've explained it to others in the past is that if you've been getting 90, let's say 95% on your quizzes, more than likely you're getting, if you do well in the exam, you'll get a 90, anywhere from an 85 to 95. But if you just barely passing your quizzes, let's say at 85%, there's a high chance that you'll get a 75 or 70% on the exam because it hasn't quite clicked yet. And in the worst case, I've seen on average, people can drop anywhere from 15 to 20% from their quiz scores simply because they didn't prep well enough. And so it is all these exams will be difficult. You will drop a little bit from what your norm is. The hope is that it's only 5 to 10%. That's the good range. Okay.
Okay.
Brother Lewis, would you recommend that we take our quizzes without the help of the book so that we
I would.
prepare for the exam? You would?
Yeah, I think your quiz access will tell you where you're deficient, right? Especially if you take the quiz access a couple different times and you finally just made it over 85%, let's say, or 90%, you'll know out of those, let's say 10 questions, where your weaknesses are. And then you can go and study those. And that will help prepare for the exam as well and make sure that you can keep up in that 90%, 95% range.
Okay, because for the exam, we can use an Excel sheet, but it has to be blank, right?
Correct. Yep. Yep. Yeah, you can do exactly what you saw me do, bring the problem up. Sometimes you should be able to copy and paste it over to Excel and work with it there, or just replicate it in Excel and then start to work out your problem.
And are we allowed to use a standard calculator on our computer? I don't have like
Yeah.
a physical one.
Absolutely. Yep.
Okay.
You sure can. Just like you saw me when I popped up my calculator, you can do that as well.
Okay.
You can do that,
Pretty
or you
much.
can use the equation formula in your Excel spreadsheet.
Yeah. Yeah.
One other thing, Brian, and this kind of tripped me up on the week 4 quiz. Question number 12 talked about price earning ratio.
Mm-hmm.
First of all, it starts with the equation, and I got the equation right, but I wasn't paying attention to the question because the earnings per share and the market value per share in the question were backwards from what the ratio is. So when I just started plugging things in, I got everything wrong
Oh, no.
because it was dividing an incorrect numerator into the denominator,
Gotcha.
or denominator into the numerator.
Yeah.
So pay attention to your questions and how they're formatted.
Yeah, and you'll have seen me do the same as I get in some of these questions, try to, explain them. I'll get going off in the wrong direction and all of a sudden realize, that's not what I was supposed to be doing. So it does help to double check, especially some of these word problems that you have to convert into numbers and do the calculations, that you're mapping it out. Very similar to what I did here, right? I have preferred stock at 80,000, par value 5. Okay, and then I need to calculate what the amount owed is. And so just work through it little by little until you get it all figured out. Okay, any other questions on the exam? I would suggest, okay, some folks have asked, where is that exam? I think where's that exam review from last year or last semester?
I saw, because I went through it today, so it's on your,
Yeah, it should be in week 6 because I always do it a week after the week of the exam. So where'd that go? Oh, there it is on top. So it'll be this one right here, office hours exam 1 review. And this is where I go through, I'm not sure if it's a 10, usually it's around 10 different problems where most of the class got it wrong. And that way these questions may not be on the exam directly, but they're concepts that individuals got wrong in the past routinely. And so at least you'll get a preview of what that could look like in the exam that you take, and how to work through some of them. Some of them are just yes, no questions, and the logic behind them. Others are full workouts of how to get to the answer. So it'll help you prep a little bit, give you an approach, because usually the values are different. Sometimes the questions are set up a little bit differently. So don't take it as gospel in terms of, these 10 questions will be on the exam and this is exactly how to work it out, but definitely my thinking on how to approach some of these questions. Okay. Anything else? All right. Well, I think I've overloaded you with plenty of information. Please make sure to relax, say a nice prayer, make sure your tummy's full of some food so you're not grumbly while you're doing it, hangry as I usually am.
All right, Brian, you
Right.
just freaked me out here. You were showing
Why?
stuff on YouTube.
Yeah.
Is there a whole nother issue or area of information that I'm not getting?
Okay, so.
It's all attached to the
I-
announcements, isn't it?
Yeah, yeah, it is. So when I send the announcements out, those links are taking you to YouTube videos, right? All those videos I have collected from the past and future and current into weekly playlists, right? So if you want, you can go to my channel. I'm not making any money on this, believe me. It's just a nice, easy way for me to keep track of all the videos I've done. And so I can reuse some ones in the past, so you can see some problems that have already been worked out when you get to a week and you think like on here, week 6, there's guidance on ethics. There's a week in here, a couple of weeks where I've actually gone through the problems and I've called them out. So like, let's look at week 5, see if there's anything in here, if I can find it. Week 5. So on some of these, no, not on this one. Maybe it's on week 6. No, it keeps on opening up separate ones. Week 6, week 7. Let's look at week 7. That's coming up. Quiz access. This will be a good one. Actually went through some questions on quiz access. So not all of them have a lot in there right now, but quiz access problems, chapter 3, quiz access. Yeah, so I've done a couple of different videos on specific problems that you'll run into generally, more than likely in some of these quizzes. So you'll see the approach to working them out. Does that help, Todd? Did you find it?
Well, I found it on YouTube. I didn't find week 6 on YouTube, but I'm going back through the announcements trying to see what I missed.
Well, okay, Nikki, anything else? Magda, you good?
Okay, perfect.
I can hear myself. That's a sad, that's so horrible.
All righty. All right, I'll find it one way or another.
Okay. It's there. All right. Well, you have a great rest of your evening and I hope you have a great exam as well.
All right.
Thank you.
I have a personal
care.
question for you, Brian.
You betcha. I'll hold on
You.
and I'll stop the recording.